With the PSEI down 200 points last week, is it buy the dip? And with the S&P 500 reaching all-time highs, is it time to sell? Let's discuss. My name is Den Slim, and welcome to another episode of Monday Market Outlook. Now, the World Economic Forum kicked off last week at Davos, and the headline topics were AI and climate change. But it was the China report that had some significant impact on the markets as the Chinese premier announced a 5.2% GDP growth, surpassing the government target of 5%. While this was supposed to be good news, the announcement was met with skepticism. Apparently, the growth came from a rebound in consumption as China's consumers returned to shops, restaurants, and hotels after COVID restrictions were lifted. Questions over the official 5.2% figure stems largely from whether the consumption boom was enough to offset the drags on China's economy. While the 5.2 figure was above expectations, we also have to put this figure into context because despite the higher than expected growth figure, this is still one of China's worst years of growth since the 1990s. Also, China's population has been on a steady decline, with the latest figure showing a decline, an actual decline in China's population in the last 2 years, and a decline of 2.08 million just last year. Lastly, China's property market, which represents 30% of their economy, is in shambles, with home sales falling by 8.5% year-on-year and property investment down 9.6%. So while China's growth was attributed to consumer spending, note that the December read of 7.4% was actually below expectations of 8%. So this sent the Hang Seng Index tumbling to pandemic lows last Wednesday, where there were actually zero stocks in the green. So how does this affect our local markets? Let's look into some of the Philippine stocks with China exposure. First up, we have SCC. So while we've had a great year in 2023, 65% of their coal exports were to China. So we could assume that China may have stockpiled coal reserves for 2024 and may not have the same level of coal demand this year. But who knows? China might surprise, and of course, this can still be good for SCC, but so far, SCC is still trending upwards as investors continue to anticipate its dividend declaration for April. Next, we have SMPH. SMPH has been lagging behind Ayala Land, and maybe part of the reason could be due to the lackluster mall growth performance in China, because compared to the Philippines mall growth of 41%, their China malls only grew by 11%. Lastly, we have Jollibee, where their same-store sales growth for the past 3 years has been struggling, but we did get a semblance of promise in the last 3 quarters. So are we saying to avoid these stocks? Not necessarily. While they are still part of our stock picks, it is worth noting that their business outlook can still be influenced by things happening in China. So we also have to take these things into consideration when choosing these stocks. Now let's look at the PSEI charts. The market had a massive correction last week, with the index falling 200 points to end the week at 6,500. We did expect the index to either consolidate here or retrace back to 6,550 given the weak signals on the RSI and the MACD. But with a strong downward move like this and breaking through support, rallies at this point may be met with sell demand, and the next critical level of support will be back here at 6,400 and 6,375. But for this week, coming off of a strong rally of the S&P 500 last Friday evening, we could hopefully see buyers come in and help the markets consolidate here at 6,500. After which, the best case scenario is for us to rebound and challenge this trendline resistance here. If not, then 6,400 may be a good opportunity for investors to buy back and help the markets rally. In the next couple of weeks, the PSEI rebalancing will be due, and for now, it doesn't look like there will be any changes in the index lineup. However, we may see some adjustments on the weights for some of the index names, particularly BPI, whose weight may be adjusted from 8% to around 8.425%. And we may see some downward adjustments on the index heavyweights such as SM, SMPH, and BDO, which could explain the recent weakness of these stocks in the past few weeks. Let's move on to the global markets. U.S. economic numbers again surprised to the upside, reinforcing a soft landing scenario for the U.S. economy. Retail sales up, building permits, and housing starts also better than expected. Jobs market staying resilient, and consumer sentiment even popping to 78.8% from a consensus of 70. This brought the probabilities of a rate cut tumbling down to 48% as the market has realized that the Fed is serious about not having rate cuts until July of this year. Now remember that this March meeting, the 48% here was 76.9% just 1 week ago. So of course, this sent the 10-year bonds to another week of gains as it rallied towards 4.126. And usually when bonds starts to rally like this, markets go down. But despite that, the market didn't seem to care as the AI hype continued to dominate the storylines, as we saw the S&P 500 break into new highs, primarily driven by the semiconductor and tech stocks, with the SMH ETF climbing up 8.12%, followed by the technology sector up 4.36%. And aside from the communications and the industrials, all sectors were actually in the negative last week. So let's look at the S&P 500 charts. The S&P 500 reached all-time highs, breaking out of our heavy resistance at 4,800 to end the week at 4,845. While we did like the idea of a retrace back to 4,600, and note that the 4,600 level was the maximum pain level for the third week options expirations, we did expect the markets to consolidate within this narrow range while we await earnings results. And earnings from Taiwan Semicon and Supermicro convinced the market that the AI hype wasn't over, and this sent the S&P 500 breaking out of the 4,800 resistance. So at this point, the next resistance would be along 4,900 or 4,950. Now usually a breakout from consolidations like this breaks out to the height of the consolidation, which corresponds to 4,900. Also, if we draw a Fibonacci chart here, we can see the extension of the Fibonacci also corresponds to 4,900, with some soft resistance here at 4,863. So the S&P 500 could consolidate around this level before continuing its upward move to 4,900. But also we have to take note of earnings this week, as we see tech earnings start on Tuesday, with Netflix reporting, followed by more semiconductor stocks like ASML, Lam Research, KLA, and of course IBM and Intel. These are the implied volatilities for next week. Netflix with a potential 7.5 gain or loss depending on their earnings outlooks. Airlines, of course, could encounter some headwinds, especially after the safety issues with the Boeing planes. So economic numbers next week, we have the balance of trade for the Philippines and the Fed's favorite inflation indicator, the core PCE numbers, coming in on Thursday. And of course, in other news, Donald Trump did secure a resounding win during the Iowa caucus, setting the U.S. up for another Trump versus Biden showdown this November. Could this be why the markets also reacted positively? Because if we go back to the Trump administration, the market did reach all-time highs, and his policies greatly benefited companies and improved earnings per share numbers. His administration was a time of tax cuts and deregulations that greatly affected American companies. So we'll see. But that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risks accordingly. And I'll see you again next week.